Yo everyone, in today's video I will discuss a bit about risk of ruin and going into more details about some specific statistics that might provide some clues about why so many traders fail in trading stock market indices. There are on average 252 trading days, and supposing that you are placing trades on each of these days, it would normally be very difficult to consistently make money every single day without any exception. In my personal case, there would be usually one day or two in the week that would end up red, provided I'm closing my positions before the next day. You can run your own statistics and analyze how your trading would perform on average depending on the time of the week. This is due to the fact that I tend to short sell more often than not, and expect too frequently that markets won't turn from negative to positive during the same day. I notably found out that many markets would on average turn green after 2 or 3 consecutive red days, especially in bull markets. A follow-through would generally occur when the session closes near the low of the day. In some more extreme bearish cases in very recent history, it seems that we usually do not exceed 4 or 5 negative days in a row. Any figure above accompanied with higher volatility will signal a large negative market and sentiment shift, so appropriate actions will have to be taken. Interestingly, bullish streaks can persist for extended periods. The S&P 500 index also tends to display more positive days within a year, as shown in the following chart analyzing data from the 1970s to 2022. Examining market intraday reversals can also provide valuable insights for active traders. Major data and news release can also greatly impact your performance, so this has to be taken into consideration as volatility could spike up and as volume and liquidity could turn around. In order to be conservative, it could be safe to assume that there will be usually 1 to 3 months of the year where results could be poor because of seasonality effects, short-term black swan events, or simply bad decision taking, just to name a few. As human traders, we must accept that we cannot constantly outperform all the time, although many people will strive for perfection. When at machines, even very good automated trading could lead to drawdowns over time when market conditions suddenly change. So let's assume that I can be trading profitably only 3 days a week and 9 months in a year. I will simplify and consider based on the formula on the slide that would be profitable 109 days out of 252 trading days. This would translate into a yearly winning percentage of 33.25%. Provided that more money is made, for the sake of simplicity, let's say that I make a choice for my losses and that I risk 2% of my account per trade. The risk of ruin with a loss level threshold of 20% will be 7.25% based on online calculators. If I set the percentage of risk per trade to 1%, the risk of ruin dramatically drops to 0.53%. Based on solely this method, the Kelly criterion is also another popular one. It is shown that with an expected win rate of 43.25%, as long as my profits are twice larger than my losses of 1%, there would be only a 0.53% chance that I lose 20% of my capital over time, no matter the number of trades. This implies that as long as I do not lose more than half my average daily gain throughout the year, I could stay in the game for a long while. To put things in perspective, here is a chart that indicates the probability of X consecutive losing trades within each 100 trades. Note that the percentages are rounded up, since that, for instance, even with a win rate of 5%, it's not likely but still possible to not have 10 consecutive losses in a row in a simple 100 trades. If we assume that my win rate is 45%, then there is almost a 50% chance that I lose 7 trades in a row according to the figures. That percentage is high enough to consider that will often be the case. If I risk 3% per trade and lose 7 times consecutively, then my account would be reduced by 21%, which by many hedge fund standards would usually be considered excessive and lead to redemptions and eventually shutdowns. By reducing risk to 1%, the watermark would be difficult to reach. The chances would be 0.23% for a win rate of 45%, an average win-loss ratio of 2 to 1, and a loss threshold of 20% regardless of the number of trades. Obviously, it isn't as simple as this, as emotional and cognitive biases would eventually kick in at some point. Positive expected values could shift over time, depending on market conditions as well. Sometimes, too many consecutive losses can also be indicative of changes in market conditions. It is not only interesting, but also very important to review what went wrong. Here's an example of events that can be analyzed in order to root out some causes of your trading edge issues. Let's suppose that you're constantly losing because of sudden large momentum and FOMO price action. You might look for breakout structures and patterns and analyze how they repeat in different time frames across different products. You can see if there are some tweaks depending on situations, and find out what the optimal balance is in terms of targets and risk money management, including speed, velocity, and volatility analysis. You can note down what your biases are and compare them with the signals you get. Sometimes your biases will work and not your current signals. Sometimes it would be the opposite, and you will tell yourself that you should rather have had followed the signals instead. There are also times when almost nothing works, and you literally get whipsawed and slowly deplete your account by 1,000 cuts. In such market regimes, extensive analysis of multi-layers of your trade's maximum adverse excursion and maximum favorable excursion can probably prove to be useful.